You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hello, everyone, and welcome to today's podcast. It's going to be a SoloCast, and it is Thursday, June 11th, 2020. It's about 7:30 in the evening after the market closed, and the reason we wanted to do a SoloCast today was so that I could give you a quick update on the state of the stock market. But before we get started, as always, a few housekeeping items here. If this is your first time listening or watching, thanks for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more in each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So please come back often. Feel free to subscribe on iTunes and YouTube. You can subscribe on both. So if you want to listen, check out iTunes. If you want to watch, you can watch on YouTube. In addition, you can also follow me on Twitter at Adam Koch and on Instagram at Financial Surgeon. Last but not least, just to reiterate, since we're doing this SoloCast as a stock market update, please note that all links, visuals, charts, and other educational resources are located on our website at libertaswealth.com. But that's all with the formality, so let's go ahead and jump into this and get started. The title of this week's podcast is Mixed Signals, because that's pretty much going to sum up what the stock market's doing right now, is giving us mixed signals. I want to share this quote. Jason over at Sentiment Trader, great research, actually said this just today in their daily report. He said, after nearly 3 decades of investing, I've learned to let go of the idea of perfection. And I think we could all learn a lot from that just by understanding the fact that it's impossible to be perfect. It's impossible to buy at the bottom and sell at the top. And anybody who tries to do it, it's a losing battle. You're just going to get really, really frustrated. In fact, anybody who tries to do to look back in hindsight and say, oh, I could have bought there, I should have bought there, and then in hindsight, moving forward to say, oh, I should have sold there. So I guess the point is there's no such thing as perfect. And of course, in hindsight, everything looks perfect, or it looks like it could have been perfect. But I think that the big lesson with this quote is just to take things in stride, realize that there's no such thing as even close to perfection, and to just kind of move forward from there. The next thing I wanted to show you was some good news. So we had a couple good things happen this past week. One was the market closing above its 10-month trend for the first time in a couple months since this whole breakdown, and I'll show you that later. But the other was Walter Deemer coined this phrase, breakaway momentum. And basically what breakaway momentum is, it's a big breadth thrust. Or in other words, when you think of market internals and market vitals, it's a big thrust of market internals where you can see here on the screen, a powerful thrust evidenced by a 10-day NYSE or New York Stock Exchange advanced decline ratio of 2-to-1. And you can see, if you look at every one of these dots on the chart here, that these breakaway momentum indicators had a tendency to indicate positive market movement in the near term shortly thereafter. And remember, this is a long chart. This goes all the way back to 1945. So if it looks like some of these triggered a positive signal only to turn around shortly thereafter, just understand that was months later. That wasn't days later. So that was a piece of good news that we saw in addition to the market closing above the 10-month trend or 10-month moving average, which was also very positive. I also started to see breadth improve, so market internals improve, which was positive. And then as we move over here to the 200-day moving average, the market, as you can see on the screen here, if you're watching, if you're not watching, you're listening, just head over to our website and you can see all these charts on the web. But you can see back in late May, the market closed above its 200-day trend or 200-day moving average, which is now rising technically, which is a positive sign or positive piece of evidence. And it headed north for a little while here, only to turn around and fall right back below it. So that's what we might call a potential bear trap, or we might call it a potential failed breakout. And that's what we're going to watch right here on this particular chart, is whether or not the market can hold above its 200-day moving average, and right now it's actually below that level. The next thing I want to show you is from Ryan Dietrich over at LPL Financial, head of market research there, and he posted this chart, which I thought was great, just kind of show that we're officially in a recession at this point. So it takes a few months for the market to indicate that it's in a recession, but more importantly, what I wanted to show, or what I thought was interesting, is that we went 128 months during this last expansion from July of 2009 to February of this year, which was the longest economic expansion since World War II. But what I want to point out here is that the average recession is 11 months long. Then if this recession follows the averages, then obviously it would end sometime around January of 2021. Moving forward, obviously, some of the concerns that we're seeing in the market right now has everything to do with the uptick in coronavirus cases worldwide. A lot of this is being driven by cases entering their winter month, countries entering their winter months in places like South America, Peru, Brazil. But we're also starting to see an uptick in places like India. We're seeing an uptick in places like Texas right here in the United States. So that's obviously a concern that we want to be paying attention to. And that was a big reason why we saw the market drop right back below its 200-day moving average after only spending a handful of days above it. So that's, again, this is fundamental. It's not necessarily technical, but I definitely think it's something we really need to keep our eye on. When I look at my trend model, or in other words, my I call it weight of the evidence model, like I mentioned earlier, the 10-month trend or 10-month moving average closed positive for the first time in 2 months, and that was on June 1st. And the 200-day moving average, that's the first trend indicator here, that went negative today after triggering positive just a couple weeks ago. So again, when we look at this trend model and you look at all the indicators, what we're seeing is generally kind of a mixed message. It's not positive. It's definitely leaning slightly negative. So the question now, I think, needs to become, is the market going to kind of consolidate here, digest the gains, and then head northward? And that kind of seems like what it might do, but there's this big coronavirus thing again. Are we going to see an uptick in coronavirus cases, coronavirus deaths? Are we going to see problems with more and more companies declaring bankruptcy? Last month, May, was the highest number of bankruptcy filings since 2009, and I think we're going to have to pay attention to whether that trend increases or if it decreases, and if the worst is behind us, which would obviously be constructive. And then this is just an asset class ranking that shows the relative strength between different asset classes, and as you can see, cash or money market is still ranked number one. Bonds are very, very closely behind it, and actually U.S. stocks are actually very close behind bonds. So we're kind of reaching this inflection point where either A, leadership is going to change, and we're going to see some new highs in the market, and we'll see a positive, healthy trend, or things are going to come back and consolidate, or maybe even head lower. And I think that's where patience is really, really important. Now, I promised I would show you that 10-month trend or the 10-month moving average, and here it is. So this is a long-term chart going back to late 2007. The red shaded areas or rose shaded areas are when the market is below that 10-month trend line, which is the line you see here that kind of smooths out the ups and downs. Each one of these candlesticks is 1 month, just so you know. So whenever we see the market close below that level, that would be negative. When it's above it, it'd be positive. So you can see going back to 2008, we've got a couple whipsaws here, or head fakes we might call it, here in 2010, really quick for 4 months, 2011 for 5 months. We had a horrible period, just nasty for almost 2 years between 2015 and 16, where things just kind of went sideways and whipped us to death. And then we've got just kind of this messy area up here between 2018 and present, which has obviously also been pretty nasty. So the question right now becomes, can we hold above this 10-month moving average? And then in the bottom pane, we have a negative divergence that takes a really, really long way to work its way out. And right now, that negative divergence is still technically valid until proven innocent. So that's what we're looking at today. I wanted to keep this relatively short. So in conclusion, again, the market trends are mixed at best. Longer-term indicators are recently turned positive, but we're starting to see these trends maybe even flipping right back to negative again. This next day or two, or this next couple weeks could tell us a lot. We'll just have to see what happens and how fast things move. I would obviously like to see the market's vital signs, so those breadth indicators, internals, continue to improve to offer more evidence that things are healthy and not heading lower. And then I know that there's this phrase, buy low, sell high. I'm not sure who coined the phrase buy high and sell higher. I should probably look it up. But the reason I wanted to share it today was just because going back to the beginning of the podcast, I mentioned trying to buy at the bottom and sell at the top is impossible. I mean, it requires clairvoyance, a time machine, or both. And we don't want to necessarily try to be heroes here and try to buy at the bottom and get every short-term trend. We want to buy healthy trends when the wind is at our back, when the wind's in our sails. And basically, we want to buy high and sell higher. That's where most of the money has been made in the market, is by buying high and selling higher, not trying to be a hero. So in conclusion, think long-term, and remember, patience is huge. And I'll close out with this quote by Michael Batnick. He just actually put this in one of his blogs today. And he said, investing hurts. The market has only hit an all-time high 7% of the time, which means that if you open up your account on any given day, there's a 93% chance that you're underwater. So again, understand that this is a marathon, not a sprint. One day is not a trend, and honestly, neither is a week or even a month. So we have to take our time, be patient, pay attention, and make sure that we're putting the risk-reward calculation at our backs and not investing against the trend. So that's all for today. If you'd like to discuss your personal situation further, remember that you never have to be a client to ask a question. So head over to our website if you have any questions, or if you'd like any confidential information discussed, we'd be happy to do so, and you can reach out to us privately there. We realize there's thousands of podcasts out there, and you chose to listen to ours, so thank you so much for listening. Be sure, again, to subscribe both on iTunes if you want to listen and on YouTube. Please feel free to share this podcast with your friends, and if you want more educational information, you can sign up on our website at libertaswealth.com to receive our screencasts, videos, and articles that we send out on a regular basis. Again, you can follow me on Twitter at Adam Koch, Instagram at Financial Surgeon. So again, thank you so much again for watching and for listening, and we will see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.